That's why you don't have me for managerial. You don't want me to do inventory because you just start hearing it over and over again. All right, so that's that part there. Now, the step 3 is then we'll take a look at the current these assets here. Assets and then our liabilities are current ones. So that's what we're going to take a look at on this. So accounts receivable increased is deducted from the net income. It's because
we've got.
yeah, because in any case the sales on account were $9,000 more than cash received. That's why. So therefore, we are not collecting. So therefore, that's why we will file away. And so those are something we did not receive in cash in the year. So that makes sense? So we're doing the opposite. All right, we've got something there. All right, the inventories here is an $8,000 decrease is added to net income because $8,000 decrease in inventory indicates that the cost of merchandise sold exceeds the cost of merchandise purchased during the year, $8,000. So we have a decrease in that, so we have to pay it out to get that. Now the accounts payable, merchandise creditors, so we had a decrease in this, so that means we didn't pay our creditors as much. So therefore, we'll add that in. Oh, wait a minute, do we decrease it? Yeah, I'm sorry. That is yeah. See, I'm getting tired again. So we had a decrease in accounts payable, therefore, because we paid them down, so we paid more. Therefore, we will decrease that also. Yes. I'm getting tired. So I get myself all confused here. So accrued expenses payable, we have an increase is added to net income. So we have an increase in that. We add that to net income because we didn't pay our bills on those expenses there. And then we have income tax payable. We have a $500 decrease. Since we have a decrease on a liability, we will then decrease cash on that. So we'll take that away. So let's take a look at what all this looks like together. So in here, we have a decrease in accounts receivable. Increase, we're going to add it. An increase, we're going to take it away. We're going to decrease there. So we're going to add again our inventories that decrease. And then we have a decrease in accounts payable. An increase here, and then a decrease. So it's opposite what happens on assets versus liabilities. That's the thing to remember there when you're going through that. Just really, how does it affect cash?
What's the purpose of doing this?
So that way we can see what's happening, where the cash is going, and what's happening with the company. So if I'm a person looking at the company from the outside, well, what's happening? Why is this changing compared to before? Well, we're not paying our bills, or are we, we're collecting? We have an increase in accounts receivable, or we're not collecting on our, what's happening here? So it's kind of giving me a view, if I'm somebody from the outside, of what's happening. Why is our cash going up or down? Because I want to know what's happening with our cash. If I'm looking at the company, because that means
look at the regular income statements and stuff.
well, we can look at the income statement and see it went up or down, but why did it? There may be a reason. Well, we could have took out lots of loans to get that additional cash. And if we use that money, if we're taking out lots of loans to get that increase in cash, it may not be a positive thing, right? So we could raise my cash up by quite a bit. Why are we doing that? How are we doing that? And so from the outside, I want to have a little more information of why this is happening. So when I'm looking at that, not just as an investor, but maybe for somebody that's maybe also going to collect a loan. All right. So these changes are some of the things that have happened here. These are our operating activities. All right, this is transferring it over from the previous slide here. So this is statement of cash flows. Basically breaking this down. This is our net inflows from operating activities. This is a positive thing. It should be a lot. We should have quite a bit here, because that's what we primarily do. If it's not high here, then we're not doing something right. Now, we have cash dividends were declared, so that's going to be some of the things that we'll take a look at in a moment. So we have that, and then we paid it within the year, okay? So that's good. So then we paid that out. Payable only 24,000. Oh, 24,000 was paid. Here, there's two more one was paid out. We owe a little more. So we're saving a little bit in that area because we have not paid some of it out. And granted, we have that liability, we gotta pay it out next year, but we're focused on what actually left us, $24,000. So since we have that, we'll take a look here at 24,000, and then that will go into the financing activities. We've skipped the investing at this point in time. So we have this paid out for 24,000 here. Now we're going to take a look at our common stock here. So we issued for cash. That's a positive, bringing in some money for us. So that's what we have here. 16,000 went up 8,000. So that's a positive move. And we have additional paid in capital on that above the par, which is, oops, let's go back. The 40,000 on top of that, 8,000. So now we have 48,000 right here. Now that's a positive in there because we got cash in for it. So that's what we're taking a look at here. And then we're taking away for cash dividends. And then we have any retirement bonds payable. So in here, we had to pay off this debt from bonds payable of the $50,000 that we have right here. So we'll take that away out of it because we had to pay something, which is not cash. So that's why we have that. So our net flows from finance activities, as you can see, is going to be a negative. So we'll total that in a minute here. So now we're moving into our investing activities, looking at a building here. So we purchased for cash $60,000 building. So we have $60,000 we're taking away because we used it to purchase that. Looks like we have received from the sale of land. So we have some money we're going to be getting some cash in from that. And then we also purchased some land also. So let's take a look at that one, what it is here. So in here we have two transactions I just spoke about. One, we sold land. And then we purchased some land here. Now remember this, we credited it there because we had the gain on sale and we used the operating activities up there. That's why there's a difference between the 72 and the 60, if you wonder what that is. And then we had the $15,000 that we used to purchase that. So there's that 12,000 that we saw already, we already taken account for up in here somewhere. And now we're going to put these two in there. So we have the 72 received from that, and then the 15. Now we've already taken it away up here though. So now it's 60. And so now we can figure everything out. All right. Now, one of the things is when we figure all this out, it needs to balance. So my increase in my cash account should match my increase at the bottom right here. So this increase here should match my balance sheet increase from the previous year. From that to the new year. So we went up 71,500. It should show that. So this is what's increased because we had 100,000 here, we lost 3,000 here, we lost 26 here. So we have a $71,000 increase. And so if I look at that, if I went way back, it would show me that my cash account has gone up that amount. And so here I would put my beginning balance and then my ending balance, and I should be able to come up with a difference there. That should be it. So that's what you can see at the bottom of the didn't show it. All right.
So on the balance sheet, okay.
What's that?
I was just looking for that 71,500 to happen.
It's not up there. It's on page 647,
Yeah.
and it says increase 71,500 in the cash account. So that's where it should match that, whenever that changes. And so yes, it's a long way of getting something that we already know. Yes, we already know this, but we're trying to provide a picture, that's what our financial statements do, of what's happening within our company, so people can make educated decisions about our company. So most of the time you're doing this, you're a publicly traded company, or you're providing this to somebody that is interested in providing you a loan or something like that. All right, let's take a look at a couple problems. We're going to do two of them. So the first one I want you to take a look at, I want you to look at the example before we jump into it, which is on page 649. So on page 649, you'll see an example, a real simple example of a indirect method.
So basically, in time that cash is being depleted, you're adding it every time it's being paid to money. That's around it.
So first things, we're going to make some simple ones, and then we'll jump into the other operating activities. So in here, if we look at the example on 14-2, there's a few things that happen. We had depreciation there, so we have 12,000 of that. We have amortization of the patents, and then we had a gain on sale of land. We're going to pull that out because we already recognized it in our net income. So we have to pull that out of it. So if you're seeing that, I want you to then do PE 14-2A. Use that example to kind of help walk you through it. And that is on page 671.
Which one's who?
Yes, please.
Okay.
Just kind of follow the model they've given you on the page 649. So I'll start you off here. You should start off with net income.
Oh, I put the wrong amount there. Oops.
Did you do the loss of $4,000?
Add it back in.
13.
You're going to add that back in to the loss.
13.
I kind of shortened this, just your adjustment to operating activities here. You have your depreciation, you have your amortization of patents. Then we have a loss on this swim sim land.
Also, the depreciation of the furniture brought down the.
Yeah, so we're adding that back in.
Yeah, adding it.
The reason we're adding that back in, we took it out.
Yeah, we're gonna
We
see where
depreciated
it's
it.
from.
Was that, yeah. So we're putting it back into it because that was our depreciation expense. And so we pulled it from that income already, so we're gonna put it back into it. It should, so that way we can get an accurate reflection of what's really happened. So how are we doing?
you add the depreciation and that.
Yeah, because we're taking those
And then
away.
remove the sale of land.
Yeah, because we took a loss on that.
So I
So
got 113,740.
we're adding all these into it.
Adding all of them?
Yeah, you're adding all that back into it. Those are all positive numbers, we're adding into that.
Oh. Oh, loss.
Yeah, loss is the opposite, so if we had a
Okay.
gain, we would take that away then.
Okay.
All right, questions on this one?
Do we need more?
Yeah, if you want to do we're going to do another one that's a little more depth in this.
Okay, yeah.
That's the next question we're going to do. So if you want to turn your page to, we're going to do the other portion of this, which is on page 651. We're going to do 14-3. Take a look at that one. That's an example.
Okay.
And then we're going to do the problem that goes with that, which is PE 14-3A.
So we're doing the change between the 2 years. Okay.
Yeah, so now you're gonna take a look at all of the operating assets and liabilities, and do that next portion we took a look at earlier. And then I'm gonna have us work on a problem that's a little more detailed. Read this for a second, let me get some 2 moments to look on it. Well, I'll start working this out on the board here for you.
No change.
What's that?
No change.
Oh, yeah. here. So we have 253,000 is our net income. And this is our assets and liability changes. Okay, so we have a decrease in accounts receivable, which is what?
Increase in cash.
An increase in cash. That's good. So we have $6,600. All right. So then we have an increase in inventory. Remember, that's an asset again. So if we have an increase in inventory,
Decrease in cash.
decrease in cash. That's right.
Back.
All right. And then we have an increase in accounts payable, looks like. Now this is a liability. So
Increase in cash.
increase in cash. Okay, so that's what you should have. Total up here. How's that feel?
A little
Okay,
better.
a little better.
A little.
You'll start to get a little bit more too as you're working through it. I think there's a video out there that has this chapter on it too, so I will have not only this problem, but some other ones on there also for you. It's already out there. All right, so that's basically walking through the indirect method. That was the hard part. Let's talk about the direct method now. The easier part.
Why don't, it says the change in dividends, payable tax, cash paid, you just ever, you don't include dividends?
Dividends will go into your financing section of your cash statement of cash flows. We only do the operating section there.
Okay.
So was that a trick?
Yes, it was a trick.
That was my house.
Was that?
That was my house.
Yeah, that was nice. Just trying to see if you're paying attention, just to check and see. Yeah, you didn't have to use that. Just wanted to kind of make sure that you have a good idea of where it goes in the sections, that's all. It's just being a little tricky, you know. All right, so objective 3 here, we're going to learn about the direct method. So we talked a little bit about the direct method. This is a little simpler here. So basically, remember when we looked at it was what we receive from customers, what do we pay out? That's what it came out to be. So that's what we'll start working on some problems, kind of showing that.
So,
Huh?
cash received from customers, is that all of your sales, including your AR, or is it just your cash?
Which we received from them, cash receipts. So if they paid on their AR, that cash counts as part of it. And what cash you received from straight cash transactions.
I'm just trying to figure out how you
Yeah.
figure it out, like you take
Yeah.
all of your sales minus your AR then? And that would be your cash?
You'll take the difference and change it to your AR again. We'll take a look at that in a second
Okay.
here. So the final amount reported in the cash flows from operating activity section will be the same whether direct or indirect method is used. The method differs on how you are obtaining and analyzing and reporting this. So in here, the direct method, sales, is the cash received from customers. We'll take out some of the things we talked about in just a few moments here. So that we have cash payments from merchants, and then you have some of these things here. So we'll make some adjustments. So make some adjustments to these things here. Get that information. We're not going to worry about depreciation expense because there's no cash transacted on this portion here, so don't worry about that. Or gain and sale land, any of that stuff. So it eliminates a lot of the other things, but like I said, you probably want to know the indirect method, even though it's a lot harder for me to know that. All right, so in the direct method, your depreciation expense is not adjusted or reported as part of the cash flows from operating activities. The depreciation has not involved cash outflow. We don't outflow on that. But since we were backing into it with the other one, you have to put that in there because we started with net income. Here, we're just starting to see, well, what are we receiving and what went out. That's all we're looking at here. So, reported sales of 1.18 million for the 2014 to determine the cash received from customers. Sales are adjusted by an increase or decrease in accounts receivable. So what's been increased or decreased? That goes to your question that you had. So we have this by sales, make some adjustments there. So in here, if we have a decrease in accounts receivable, we'll add it, because that means we collected more, right? If we have an increase in accounts receivable, we didn't collect this much, we'll take that away. So that's the adjustment we will make as a part of it. So in here, we collected, we have an increase in accounts receivable, so we collected less. So therefore, that's how much we collected in cash. Make sense? All right. Quicker than usually does. It's a lot easier.
Is this just trying to kind of find like which cash is on hand?
Well, yeah, we're basically, we're gonna get to the cash that we have on hand at the end. But how do we get there, and what were the changes that made us get there? And that's all we're doing here. We know exactly how much cash we have.
Okay.
But we're just trying to, what has happened to make this the way it is. So this company, Randall reports cost of merchandise sold of $790,000. Determine the cash payments for merchandise, $790,000 is adjusted for an increase or decrease in inventories and accounts payable. Assuming that accounts payable are owed to merchant suppliers. That's the assumption that we're making, we're owing it to them, not other suppliers. Yeah, yeah. Those type of things there. So, we have an increase in inventory. We're gonna add it, and we have a decrease. Inventories were subtracted. Decrease in accounts payable, we'll add it. So it's kind of different than what we looked at before. It's gonna get so confusing. So we'll take a look at the problem too a little bit here. And so this is what it looks like here. Inventories and accounts payable, what's happening here. So we have an increase and a decrease. Oops. All right, so now we're going to look at here, Randall reports total operating expenses of $209,000, or $203,000, I don't know what he said, 9, which includes depreciation expense of $7,000. So we have that depreciation. Determine cash payments on operating expenses. The other operating expenses, excluding depreciation, is used on that. So $196,000 adjusted for an increase or decrease in accrued expenses payable. So now we'll look at our accrued expenses here. So a decrease in accrued expenses, we add, because we paid those, and then we have an increase, we'll subtract it. All right. So that's changes there. All right. So finally, looking at this here, I'm going to look at our interest expense of $8,000 to determine the cash payments for interest. The $8,000 is adjusted for any increase or decreases in the interest payable. Actually, we have a couple more. Oops. Oh, the income tax. So we have the interest payable here, an increase in that. We add an increase. Sorry. We subtract. These are all in your book, and this is on page 659, over the top of the page. 59.
Yeah, as it says.
And then lastly here, what we have is our cash payments for income taxes. So we have our cash payments here for income taxes, $83,000 adjusted for any increase or decrease in income tax payable. So if we increase or decrease on those. So if we decrease our income tax payable, we add it, because that means we've paid some of it. And then increase in, and then we increase in income tax payable, we subtract it. All right, so let's take a look at, this is the transactions happening here, the change. Let's take a look at, you see, the cash flows, we use the direct method. So you can see the cash received from customers was that, and then you see your payments out for each of those things we spoke about, and that gives you your net operating activities. So it still should come up with the same amount for each of those. So that gives you your operating activities, and then everything else here. So this year, this year messing up here. And then these things are your flow through operating activities here. All right, let's do a couple problems here. So if you turn to page 657, you'll see an example there. PE, example 14-6. So we have our sales. It says the example here says sales reported on income statement were $350,000, and the accounts receivable balance declined $8,000 over the year. Determine the cash received from the customers. So we have a decrease in that. So we're going to add that to it. So that 8,000 will go to it. You see how they came up with 358,000. So we're going to do a similar problem on PE 14-6A, which is on page 73. So go ahead and work out that problem. All right, ready for me to put this up? We have sales of 480,000. We're going to take away an increase. Which is how much? 54,000. That leaves me with 46. That is cash received to customers. Okay? Easy? All right. Let's look at another one here. So let's do 14-7. Let's look at 14-7, the example there, which is on page 658. This one is we're taking a look at the cost of merchandise sold. So a couple of things affected it here. You'll see that you have accounts payable balance increased by 4,000, or inventory balance increased by 9,000 over the year. So we're going to add in the increase in the inventory, and then we're going to take away our decrease in accounts payable. And because we're doing the cost of merchandise sold, because we're doing the opposite there. So remember that we're doing the opposite of that, because that will we take away from our cash. So on if you want to turn in your book to page 673 again, you do 14-7A. guys a moment to work that one out. All right, how's it going? Everything good? We have this down. Given cash flow is easy stuff.
Actually, yeah, that makes me weird.
It is a little confusing in some ways, but both of them are different.
And this is due next Monday?